If you're worried about mortgage rates increasing while at the exact same time the home you just bought is continuing to go down in value, well, then this video is for you, because there is currently a massive issue coming down the pipes when it comes to Canadian mortgages. And I'm going to tell you all about that in this video. You see, recently a viewer on this channel named Ajay expressed interest in the comments about serious issues that could arise when people like him go to renew their mortgages in the future, because he is under the impression that if your home is in a negative equity position, when you do go to renew your mortgage after a 5-year term, that you would have to show up with an additional 20% down so the bank won't take away your home. But in reality, that's just not true. However, Ajay and I really did end up mixing it up in the comments quite a bit because I assumed he's just another bubble burster, jumping onto the conspiracy about the mysterious they stealing all of your home's equity and life savings. But then I thought, well, no, I doubt this viewer really thinks that Tiff and JT hang out on Friday nights trying to figure out ways to drain your bank accounts. So it must be a misunderstanding. So I figure it's my job to try and get to the bottom of this as some sort of fat self-proclaimed Canadian housing superman. But really, I'm half a moron when it comes to mortgages because I'm a real estate agent and not a mortgage broker. However, I do know one of the absolute best mortgage brokers in Canada, so I thought for your benefit, I'd give him a call.
Nah.
It's strange. He must be busy. I'll try and explain it myself. And if you think I do a half decent job of explaining something that I'm not an expert in, please go ahead and click the like button for the YouTube algorithm, because that is the best way that you can help me get this information out to other people who are worried that they're going to be in a pretty tough spot with their mortgage. Also, please subscribe to stay up to date on the market here in Surrey, BC and the Fraser Valley. And of course, if you do need personalized advice, you can book a call with me right now down below in the description with just a few simple clicks at a time that works best for you. And now on to the video with this massive disclaimer that I am not a mortgage broker. Let's start off with the scenario. Many people have purchased homes in the previous months that are already worth less than what they had paid. In the US, this is not an issue because most home buyers take a 30-year loan with a fixed rate for the entire amortization. But in Canada, the government, in name of homeowner protections, actually allows for only up to a 10-year term, with the most common being 5 years. Yep, we have 5-year terms because everybody thought it was absolutely horrible that you had to lock into a 30-year term when rates were going down. And now that rates are going back up, everybody thinks that it's absolutely horrible that you can only lock in for 5 years. But I should probably keep that topic for another video. The worry is that we haven't really seen tightening like this in the mortgage world for decades. And people are very concerned that when they go to renew their mortgage, that the property that they paid a heck of a lot for just maybe earlier this year will be worth a heck of a lot less when the renewal comes up in likely a 5-year term. So our viewer Ajay was under the impression that if you bought $1 million home and put 20% down, that upon renewal, say for instance your place was worth $800,000, that you would actually have to cut a check for another 20% of that 800 or 160K. Well, let me assure you that that's not the case. If you are on a 5-year fixed term and for some reason the market crashes and burns and prices don't recover by the time your mortgage renewal is due, well, here in Canada, the bank will offer you a new rate and continue to let you make those payments until you either successfully pay off your mortgage or you default. The reason for this is what would be the point of the bank foreclosing on a property and solidifying its loss when they still have a homeowner who is ready, willing, and able to keep on making payments. But then in our back and forth in the comments, I found out that Ajay actually didn't take a 5-year fixed rate and he took a variable rate mortgage. And that's when his worries all started to make sense to me. So a normal variable rate mortgage is more commonly known as an adjustable rate mortgage. This means that when Tiff blows up the economy by raising interest rates too fast, that your payment actually increases to compensate for the new higher rates. Hence why everybody usually takes a fixed rate so they don't have increasing payments to deal with in the future. So with a regular adjustable variable rate mortgage, yes, your payments do go up. But other than that, you are still in the same boat as the fixed rate people upon renewal. And as long as you keep making your payments and accept the new terms from the bank upon renewal, everything will be just fine and you can ride out the market until it ends up coming back historically like it always does. But the real problem comes from something called a variable rate mortgage, but instead has a fixed payment. These are often, I find in the industry, most commonly offered by RBC and TD as a way to steal away business from other banks. Reminder, I'm not a mortgage broker and this is my opinion only, so if there are banks that do this or don't do this, I'm sorry, please don't sue me. That's right, many, but not all banks offer this type of product, and you may have fallen into a trap of accepting a mortgage like this without even knowing it. Because what often happens is you end up going to a very good mortgage broker after you get your accepted offer, and that mortgage broker brokers you a deal with, let's call it Scotiabank, for a variable rate mortgage. And let's say they're offering that mortgage to you at 4%. That broker does all of the work to get you approved, and so you can buy the home. But before closing, your dad tells you to go ahead and shop that rate around to other institutions to try and get a better deal. So you walk into TD Bank because that's where your dad has banked for a million years, and you bring them your rate and say it's a variable rate mortgage. And because all of the hard work is done and they've got a month or 2 or 3 before you're closing in order to get the deal together, they're easily able to offer you a better rate for what sounds like the same product, proving that your dad is the smartest person in the world. Sounds great, right? Because now they've likely offered you a rate of something like 3.8% when Scotiabank was offering you 4%. And the latest trick that these banks are using is cash back to the tune of, I don't know, $1,000 or $1,500. And on top of that, they mentioned to you that your new low rate comes with a fixed payment, so you don't have to worry about higher payments when TIF holds his next meeting. Perfect. You're smart and just saved yourself a whole bunch of dough, right? Well, yes, as long as rates don't go up, because after all, apparently
we're going to be holding rates low until the end of 2023.
But have you ever thought about now how this second bank that's involved was able to offer you a lower rate? Well, it's because they've stripped out some of the features in that mortgage that you've just purchased. And in this case, that feature that we're talking about is the adjustable payment. So back at Scotiabank, should you have gone with them at 4%, every single time that the rates go up, so does your payment, leaving you with less to spend on necessities each month, like this magic golden 8-ball selling for $150. But that TD mortgage has a fixed payment, meaning that your payments won't go up for the next 5 years. That leaves me wondering, how can you have a variable rate mortgage with fixed payments? Well, that's where things start to get interesting, and Ajay, you might be finding yourself in a tough spot. You see, in this fixed payment variable, every time TIF holds a presser, more of your payment shifts from principal to interest. Now, this creates 2 problems. The first is something called the trigger point. That's when you stop paying down any principal on your payments at all. Yes, rates can rise so high that essentially the bank cancels the rate that they gave you. Remember that really good rate they were talking about before? And applies a new rate, and you likely have no choice but to take it. And this is actually probably the best case scenario, because then you will again start paying down principal, and yes, your payments will increase. But at least you won't find yourself in scenario number 2. And that is the scenario where you don't actually hit the trigger point. But since rates have gone up, you also don't get to the point where you end up paying off any of the expected principal that you agreed to when you signed for the mortgage. Because you see, if the mortgage payments don't pay off any principal, you still owe that money. Then the only way the bank can actually get their money back is to automatically extend your amortization, or the period of time of which the loan is supposed to be paid off. Yep, that's right. Every single time you make a payment on this style of mortgage in this scenario, more payments get added to the back end of your mortgage because you still owe the same amount. And this is where it gets really dicey, and yes, the bank may actually force the sale of your home. You see, if you outsmarted yourself by taking a variable rate but fixed payment mortgage because the bank offered you a little bit lower rate, and let's say you took that loan for, I don't know, a 30-year amortization, because you can do that if you're more than 20% down and avoid CMHC, and then rates go up because TIF is doing its thing, but also not up enough to actually hit the trigger point. Well, when you go to remortgage after your 5-year term, know The bank cannot process a mortgage with a longer amortization period than you had initially qualified for. And if your home is worth less than the day it was bought, you may not be able to take your business to another institution or even renegotiate with your current one, leaving you with two options. And I think this is the part that Ajay misunderstood. One, you have to come up with the funds to pay back the bank to get your mortgage back within its original amortization, meaning that you very likely have to cut a check for thousands of dollars or the original amount of principal that you would have paid off in the first place if rates had not gone up. Or scenario number two, yes, indeed, even if you are ready, willing, and able to keep on making those payments, the bank will be forced to sell your home or force you to sell your home, leaving you possibly with nothing because they are not allowed to amortize you more than they originally qualified you for at that time. But I must point out that if the market returns and the positive gains along with it, you will likely have greater options to refinance or even sell with a profit. So now what? Well, before you run off and take your dad's advice about only getting the best rate, please ask your institution which type of variable product they are offering. And if you find out after watching this video that you indeed have one of these styles of fixed payment variable rate mortgages, let me know down below in the comments. And then immediately run to your bank and ask them if you can, pretty please with a cherry on top, increase your payments back in line with your proper amortization so you don't find yourself in a world of pain in another 4.5 years. And of course, if you need further localized Surrey and Fraser Valley advice, you can book a call with me right now down below in the description with just a few simple clicks at a time that works best for you. Please remember to click the like button and subscribe and help me grow this channel. Thanks so much for watching, and we'll see you in a couple of days.